Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know. First, Oracle's $300 billion bet on OpenAI triggers its worst stock quarter since 2001 as Wall Street punishes the single-tenant risk. We'll analyse why this all-in strategy is a turning point and how it could affect Oracle's financial stability and position in the cloud market. Second, the UK's AI superpower dream hits an 8 to 10 year grid connection roadblock, threatening billions in US tech investment. We'll explore how this critical power bottleneck could transform the UK's tech ambitions and impact its digital sovereignty against US-dominated platforms. Third, UK streaming hits a turning point as ad-supported plans officially overtake premium subscriptions, signalling the end of the ad-free era. So we'll discuss why this shift back to ads matters, and what it means for creative freedom as platforms prioritize brand-safe content. Fourth, a $2.7 million Cybertruck donation to Las Vegas police from VC Ben Horowitz spotlights a market creation strategy for the struggling EV. In this episode, we'll break down this private gift and what it signals for public procurement and the influence of venture capital on policing. Fifth, the 33 million download Merlin AI app misidentifies birds, revealing a classic AI flaw of pattern recognition without contextual reasoning. Today, we'll take a closer look at this technical setback and its implications for user trust and the challenge of teaching AI real-world context. Oracle's stock is in a freefall, on pace for its worst quarter since the dot-com bust in 2001. Shares have plummeted 30%, erasing a historic rally from just months ago. A while back, we talked about Oracle using the TikTok US deal as a kind of Trojan horse to battle test its cloud OCI. Now, the showcase phase is over. Oracle has stretched that playbook into a single mega tenant bet, and the market is punishing the concentration risk. When we place Oracle's current pivot alongside tech history, the high stakes parallel becomes clear. Think about Microsoft in the early 2010s. They were a software giant, but saw the future was in the cloud. Under CEO Satya Nadella, they poured billions into building Azure. It was a huge risk, but it paid off spectacularly. Or think about Netflix, which went from mailing DVDs to becoming a global streaming titan. These shifts require immense investment and a total change in company culture. The question on everyone's mind is whether Oracle can pull off a similar transformation. And as we've discussed before, there's another path. Specialized AI clouds like CoreWeave that focus on one thing, training massive AI models. Oracle's move today looks like an attempt to straddle those worlds, but with one anchor tenant. So what's causing all this turmoil? A bet so big it's making Wall Street's head spin. The company has tied its future to OpenAI, the operator of ChatGPT, in a deal worth more than $300 billion. Remember, even a rumor about a single $10 billion Oracle data center deal potentially being cancelled knocked 5% off the stock a while back. This time, the numbers and the reaction are far bigger. This isn't just a partnership, it's a symbiotic risk. Oracle is building the house, but it relies on a single tenant, OpenAI, to pay the rent. And here's the kicker. While OpenAI is a household name, it's also burning through cash at an astonishing rate, reportedly losing over $13 billion in the first half of 2025 alone. The company doesn't expect to be cash flow positive until 2029 or 2030. So Oracle is staking its future on a partner that is itself in a high stakes race to become profitable. We previously analyzed how purpose-built AI clouds could carve out share. The latest twist is that Oracle is effectively attempting a purpose-built build-out for one client, concentrating both the technical and financial risk. To pull this off, Oracle is planning to spend $50 billion on capital expenditures in a single year, double its total from a year earlier. The company is also plotting $248 billion in leases and has already raised $18 billion in one of the largest debt sales the tech industry has ever seen. This lines up with something we flagged a while back, a global data center construction frenzy funded by debt and a new landlord class of investors. Oracle's lease and debt stack fits that pattern, but with OpenAI as the anchor tenant, the vacancy risk looks binary. All of this spending is fundamentally changing the company's DNA. Oracle is transforming from a high-margin software company into a capital-intensive infrastructure company. Its debt-to-EBITDA ratio has shot past 4 times, which is more in line with a telecom or energy utility. And it's not just about money. The physical challenge is staggering. The International Energy Agency projects that global data center electricity use will more than double by 2030, driven almost entirely by AI. Oracle isn't just fighting for market share, it's fighting for power, land, and a limited supply of GPUs. Continuing our last discussion about overbuild risk, the situation this time is somewhat different. The capex is even more concentrated and the payoff window is longer. This has investors on edge. Analysts are openly concerned about Oracle's ability to live up to these obligations, with one firm noting the company is barely hanging on to an investment grade rating. Another investor said bluntly, 4 or 5 years is a long time. That's just not within our investment discipline. And unlike the TikTok moment that briefly boosted sentiment, newly appointed co-CEOs now have to defend a balance sheet that Wall Street sees as all or nothing. But the rabbit hole goes deeper. While Oracle builds this massive AI infrastructure, key industry players aren't buying in. The CEO of Databricks was asked when his popular software would be available on Oracle's cloud. His answer, when customers start banging on my door saying, you need to run on Oracle, we just haven't heard that. That stands in sharp contrast to the TikTok partnership, which was designed to publicly demonstrate OCI's scale. So the thing is, Oracle knows it can't compete head-on with the cloud giants. As of last year, Amazon held about 30% of the market, Microsoft had 20%, and Google had 13%. Oracle, around 3%. Instead of fighting for every customer, they're pursuing a whale hunting strategy. Find one massive client, OpenAI, and build a specialized service just for them. It's a bold, niche gambit to carve out a place in a market dominated by titans. A few days ago, we mentioned how specialized AI clouds have won attention. Today, the focus shifts to Oracle, attempting a version of that, but with a single whale, which amplifies execution risk. This is the core of the conflict. Oracle is transforming itself, but at a staggering cost, and the entire strategy hinges on a single cash-burning partner. This massive gamble means trading decades of reliable profit for a shot at AI supremacy. To put it in perspective, Oracle's gross margin was 77% in fiscal 2021. Analysts now project it will fall to 49% by 2030. We previously framed Oracle's TikTok move as a proving ground. Well, the proof of concept has become a full-blown wager, one that's delivering the worst quarter since 2001. Speaking of the massive physical challenges of building for AI, Oracle isn't the only one hitting a wall. Over in the United Kingdom, their plan to become an AI superpower has hit a stunning roadblock. Developers are being told to expect grid connection delays of 8 to 10 years. We previously analysed how a single hyperscale campus can draw as much power as a small city. This is that abstract risk turning painfully concrete in the UK. Now, here's where it gets interesting. This isn't just a construction delay. The speed of AI development is measured in months, not years, so a decade-long wait is an eternity. We've talked before about power and cooling being the true physical bottlenecks. Substations and transmission lines move on decade timelines, even as model cycles compress into quarters. The problem is so acute that the UK's national grid is now partnering with a company called Emerald AI to pilot a radical new system. The idea is to create smart data centers that can dynamically adjust their energy use, hopefully unlocking capacity faster. It's a clever workaround, but also a sign of how tight the system has become. This isn't a problem of money. Tech giants like Nvidia, Microsoft, and Google have all committed billions to build AI infrastructure in the country, but that investment is hitting a brick wall. And as we noted a while back, the US already holds over half of global hyperscale capacity, while Europe lags. This UK gridlock risks widening that gap. This investment rush, however, brings a tough question to the surface. Can the UK truly become a sovereign AI superpower while relying so heavily on American tech giants? Research shows a staggering 94% of UK software companies already depend on US technology. With firms like Microsoft and Amazon controlling up to 80% of the UK's cloud market, there's a real risk the UK could become a high-cost data colony where the real economic value ends up abroad. We recently focused on how Europe's slower build-out could erode digital sovereignty. These UK dependence numbers bring that concern right to the doorstep. The core conflict is not a lack of ambition, but a lack of power. And it's not just generation grid hardware and raw materials like copper, which we flagged as a hidden choke point. add friction that money alone can't immediately solve. According to Ben Pritchard, the CEO of data center power supplier AVK, these grid bottlenecks are no longer isolated risks. They are actively slowing down or blocking developments across the country. The problem goes deeper. The UK currently has the costliest energy in Europe, with prices around 75% higher than before Russia's invasion of Ukraine. This is putting immense pressure on an already stretched energy system, just as AI workloads begin to dramatically increase demand. Continuing our earlier discussion, Europe's elevated power prices were already a drag. The UK spike just amplifies it. And when we say dramatically increased demand, the numbers are staggering. Projections show that by 2030, UK data centers could consume as much as 72 terawatt hours of electricity. That's more than a quarter of the UK's total electricity consumption from 2021. This incredible surge creates a direct conflict with the country's net zero climate commitments and tracks with what we covered before. Global data center electricity use could more than double by 2030 with AI as the number one driver. Criticism from inside the industry gets sharper. One executive, Stuart Abbott of Vast Data, warns that if the UK wants its AI ambitions to be durable and not just a one-year sugar rush, it has to treat AI infrastructure like economic infrastructure. He argues the real test will be how quickly pledged investment can be translated into usable computing power for UK organisations. That's exactly why we noted an analyst point a while back. When energy is scarce, powered sites become more valuable, and slow grid delivery can just turn into a scarcity premium. To be fair, a durable AI strategy is about more than just buildings and power. The UK is investing in the full stack. It has a partnership with SAS to train 7.5 million workers in AI skills, and it's home to world-class research hubs like the Alan Turing Institute and unique data sets like the UK Biobank. The talent and data are there, but they need the computing power to be unleashed. And as we discussed a while back, even the storage layer only matters if there's enough electricity and cooling to run these systems at scale. This all leads to a final stark warning from an industry expert. According to Cow Data's Spencer Lamb, unless the fundamental issues around energy availability and pricing are solved quickly, the UK risks missing out on one of the most remarkable economic opportunities of our time. We've seen how others are reacting US. Utilities like Georgia Power are planning to spend over $16 billion just to keep up with data centre demand. Unless the UK moves with similar urgency, its superpower ambitions will stay stuck in the queue. While the UK's AI infrastructure is stuck in a queue, another tech trend there is accelerating at an incredible pace. The streaming world just hit a massive, almost ironic turning point. For the first time ever in the UK, subscriptions with commercials have officially overtaken ad-free plans. So why the UK and why now? Believe it or not, the UK is a unique test case. Research shows that 68% of UK consumers actually prefer free ad-supported streaming. This is partly because they're already used to high-quality ad-supported content from public broadcasters like the BBC and ITV. Add in the rising cost of living, and you have the perfect storm for this shift, making the UK a potential bellwether for the rest of the world. The numbers are an absolute bombshell. The number of subscribers on ad-supported plans is set to hit nearly 26.5 million, a jump of almost 7 million in a single year. Meanwhile, the number of people paying for premium ad-free services has cratered, dropping from 26.7 million to 23.1 million. What's fascinating is that we're seeing the industry come full circle. Streaming was sold as the revolutionary escape from cable TV, no ads, watch what you want, when you want. But now, with rising prices and fragmented content, it's starting to look like a more expensive, confusing version of the cable bundle it was supposed to kill. Some analysts are even seeing a trend of cord reviving, where people are so fed up they're going back to traditional TV. This is a complete 180 for an industry that once sold itself as the ultimate escape from commercials. No one championed that idea more than Netflix. As recently as 2019, its then CEO, Reed Hastings, promised Netflix would be a safe respite with none of the controversy around exploiting users with advertising. But the implications go far beyond just a few annoying ads. That promise of being a safe respite allowed for incredible creative risks. Think of the edgy shows that defined the golden age of streaming. Now, the big question is whether the need to keep advertisers happy with brand-safe content will lead to safer, less interesting programming. We might be trading creative freedom for a lower monthly bill. That promise is now ancient history. Facing a post-COVID growth stall, Netflix reversed course and viewers are following the money. With a typical bundle of services now costing £64 a month, the savings are crucial. At Netflix itself, the cheapest ad-free plan is more than double the price of its ad-supported tier. But this is more than just a few ad breaks. This shift has unlocked a fire hose of cash. The UK streaming ad market is now worth £1.38 billion, more than doubling in just 4 years. And the tech behind this ad-fueled cash flow is incredibly sophisticated. This isn't like old school TV advertising. Streaming services analyze everything: your viewing history, your demographics, what time of day you watch to build a detailed profile of you. Netflix and Disney Plus even use systems called clean rooms, where advertisers can merge their own customer data with the streamer's data to create hyper-targeted campaigns. They know exactly who is watching, and they are selling that access. And everyone wants a piece with Apple, Tesco, and McDonald's now among the top streaming advertisers. Now, get this. Apple is one of the top advertisers. This is where the situation takes a more complex turn because Apple runs its own rival streaming service, Apple TV Plus. This signals a huge strategic shift. The streaming wars are entering a new phase of what experts call co-opetition, where companies are both competing and cooperating. They're advertising on each other's platforms because they realize the audience is so fragmented. The only way to reach everyone is to show up on your rival's turf. The industry built on the promise of an ad-free paradise has now fully embraced the model it once rejected, marking a definitive end to the first era of streaming. Speaking of co-opetition and unconventional strategies, a story out of Las Vegas shows a completely different kind of market play, this time involving police cars, a struggling EV, and a Silicon Valley billionaire. The Las Vegas police just rolled out a fleet of Cybertrucks, and they didn't spend a single taxpayer dollar. The 10 tactical trucks, which the sheriff called Badass, were a donation worth an estimated $2.7 million. The man behind the gift, Ben Horowitz, co-founder of the powerhouse venture capital firm Andreessen Horowitz, the same firm that spent $400 million to help Elon Musk take over Twitter. And the story deepens. Horowitz has donated roughly $8 million in total to the Las Vegas police, including AI tools and drones from companies his firm invests in. However, if you zoom out, you'll see another layer of strategy at play, one that some call market creation. By equipping a high-profile police department with technology from companies they invest in like Skydio for drones and Flock Safety for license plate readers, the venture capital firm essentially creates a model showroom. The idea is that other police departments will see this advanced tech in action and want to buy it for themselves, creating a new market for their portfolio companies. This all comes at a time when the Cybertruck itself is in serious trouble. Sales have plummeted a staggering 63%. For comparison, sales of Ford's F-150 electric truck jumped nearly 40% in the same period. The Cybertruck has also faced 10 different recalls for issues ranging from a stuck accelerator pedal to side panels that can fly off while driving. From a practical standpoint for a police force, the Cybertruck's unique stainless steel body presents a major headache. While it looks tough, even minor dents can require refinishing an entire massive panel, with some repair quotes running into the thousands of dollars. Then there's the issue of keeping them running 24/7. Police vehicles can't afford significant downtime, but electric vehicles need a robust charging infrastructure. A standard charger can take hours to replenish a battery, and while fast chargers are quicker, they are expensive and constrain the local power grid. This has critics like the American Civil Liberties Union of Nevada asking, why didn't they pick any other type of vehicle? The executive director added, I don't know that a Tesla Cybertruck makes anybody feel any safer. And there's a real psychological reason for that. Research shows that the design of a police car has a huge impact on public perception. The Cybertruck's aggressive, angular design is heavily inspired by science fiction films like Blade Runner. When you combine that intimidating look with the vehicle's strong association with a polarizing figure like Elon Musk, it can be seen as a political statement. Instead of appearing as approachable public servants, the police might be seen as aligning with a specific ideology which can damage community trust. Other cities like Baltimore have already backed away from plans to buy Teslas for their government fleets. What's really at stake here is that these kinds of high-value donations completely bypass the normal public process for buying government equipment. When a city buys a fleet of cars, there are usually public hearings, debates, and a competitive bidding process. A private gift, often handled through a police foundation with little public transparency, skips all of that. It means a tech billionaire can effectively decide what tools our police use without any public input. The Las Vegas Police Department says the trucks represent innovation and will keep officer morale high. As for the donor, Ben Horowitz, when previously questioned about his tech-centric police donations, he had a message for his critics, quoting the rapper Nas, "You can hate me now, but I won't stop now." We were just talking about a tech donation that's raising a lot of eyebrows. Now, let's shift to a completely different story about an AI application that, on the surface, seems to be universally loved. An AI app that identifies Birdsong has absolutely exploded in popularity, hitting a staggering 33 million downloads worldwide. And interestingly enough, the app is completely free. This is significant because Merlin is run by the non-profit Cornell Lab of Ornithology. It sustains itself through donations and grants. Over 75% of its funding comes from individual donors, a huge contrast to for-profit apps that rely on ads or selling user data. It's called Merlin, and its growth is off the charts. In Britain alone, users skyrocketed 88% in just 1 year, with a 30% increase in new users every single month. Fans are calling it a game changer. One writer put it bluntly, "This is what AI and machine learning have been invented for. It's the one good thing." The app is being praised for connecting millions to nature. But if that was just the appetizer, the main course is just being served. For all its success, the app is making some wild mistakes. The first time one 12-year-old boy used it, the app detected a northern cardinal, a North American species not found in Britain. In another case, guides at a nature reserve report that the app repeatedly sparks false excitement by identifying a common jay as a rare golden oriole. And that 12-year-old, he's now an expert birder who enjoys fooling the AI with his own uncanny bird call impressions. This points to a fascinating duality. On one side, the AI is a marvel, but on the other, it exposes a classic flaw. You see, just like humans, many bird species have regional dialects. A robin in Scotland might sound subtly different from one in southern England. The Merlin AI needs a massive library of sounds to learn these variations, but right now, it only has enough data for about 20% of the world's birds. So a misidentification might just be the AI not recognizing a local accent. The core problem, according to one expert guide, is simple. Merlin can't do habitat. The AI doesn't always account for geography, leading to impossible identifications. This reveals a fundamental weakness in many AI systems. They are brilliant at pattern recognition, matching a sound to its library, but they often lack contextual reasoning. The AI doesn't know that a cardinal doesn't live in Britain. It just knows the sound is a 98% match. The good news is, developers are working on this. They're trying to integrate GIS data and habitat maps to give the AI a sanity check before it makes a suggestion. It's like giving the AI a field guide and a map to go along with its super hearing. This has naturalists concerned with one warning of a risk that people don't learn and just abdicate responsibility for learning to Merlin. This concern taps into a bigger debate about what some call the gamification of nature. When an app gives you instant answers, it can feel like you're just collecting species IDs rather than engaging in patient observation. The fear is that this digitally mediated experience might change our psychological relationship with the natural world, making it more about quick wins than deep connection. But there's an incredible flip side to this story. With 33 million users all contributing geolocated birdsong data, Merlin is accidentally creating one of the largest real-time ecological datasets in history. Scientists are already using this massive amount of bioacoustic data to gain new insights into how climate change is affecting migration patterns and to monitor biodiversity on a scale that was previously impossible. So every time a user logs a bird, they're contributing to a global science project. The bottom line is that a powerful AI is bringing millions of people closer to the natural world, but it's also creating a new tension between technological convenience and real-world expertise, proving that even the most advanced systems can still be fooled by the call of the wrong bird in the wrong place.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.